Hi, welcome to today's presentation on retention credits. My name is Todd Koch. I'm a partner at JAK, and we're here to help guide you through how you can get additional help for your impacted businesses by proper use of the employee retention credits. Today, we're going to talk about the new expanded 2020 eligibility rules, how you can get a new 2021 credit, potential integration with the employee retention credit and your PPP loan, and let you know how to get further questions answered. What is the employee retention credit? This is a tax credit, and it's a tax credit you claim on your employment tax returns. That is your 941 for those of you that file quarterly payroll taxes. And the reason it's going to be claimed there is this credit is allowed for many nonprofit organizations too. So this allows people that don't pay income taxes the credits for retaining their employees too. The credit has been enhanced and eligibility has been expanded. And a big change is you can have the opportunity to get an employee retention credit even if you received a PPP loan. This is a major change. For most of our clients, we didn't even talk about employee retention credits because the PPP loan itself was better. However, now you're allowed to have both assistance programs, a PPP loan and an employee retention credit. So you're going to claim the tax credit on your payroll tax returns. You can get immediate access to the credit by reducing your payroll tax deposits that you're otherwise required to make. And if the payroll taxes are less than the credit, well, then you have the opportunity to get a refund of payroll taxes. There's also an opportunity to maybe obtain a advanced payment from the IRS. So let's take a little closer look at the 2020 employee retention credit. For 2020, the credit is capped at $10,000 in wages per employee for 2020. This is a $5,000 credit because the credit is 50% of the wage. To receive this credit, you either needed a 50% or greater decline in gross receipts in a calendar quarter of 2020 compared to the same calendar quarter of 2019. And if you have 100 or fewer FTEs, you can get a credit for all your people, whether they are providing services or not. If you have more than 100 FTEs, you get a credit for people that are not providing services. Talk about that again. So the FTEs, the credit difference is significant. If you have more than 100 FTEs, you get a credit for people that are not providing services. 100 or fewer FTEs, it's only though it could be everybody that you paid in the quarter, assuming that they meet the limitations of $10,000 in wages in 2020. The 2020 rules themselves were not changed for the calculations. What changed is who is eligible. And the big change to that is people that got PPP loans are eligible. So what you need is a qualifying quarter. You get a qualifying quarter if your business was suspended. If there was a shutdown of your business, that gets you to a qualifying quarter. But a nuance here is if you're using this particular exception, it's only the wages paid during the shutdown period are qualifying wages. For example, if you were shut down from March 15th to April 15th, 2020, you have a qualifying quarter in quarter one and quarter two because you have wages in both those periods. But the only wages that will qualify are wages from March 15th to March 31st in quarter one and April 1st to April 15th in quarter two. So if you're using that particular exception, that's those wages. It's much more limited. If you can meet the gross receipts test, however, that'll expand the qualifying wages to all the wages paid within the quarter subject to limits. So for the gross receipts test, you compare calendar quarters of 2020 to the same calendar quarter in 2019. If your gross receipts in that calendar quarter are less than 50% of what they were in 2019, you have a qualifying quarter. Then you will continue to have qualifying quarters until receipts have returned to at least 80% of what they were for 2019. Once you are above that 80% threshold, future quarters will not automatically qualify. They'd have to qualify on their own. And all wages paid during that qualifying quarter, if you're using the gross receipts reduction, will qualify for this credit. So let's take a look at what this really means. Examples always help me out. So if the gross receipts in quarter 1, 2, 3, and 4 for 2019 were 100, 120, 100, and 150 respectively, and in 2020, the same quarters were 40, 70, 85, and 115. Let's take a look at what qualifies. So in quarter 1, our gross receipts are 40% of 2019. So that means I'm going to have a qualifying quarter. In quarter 2, I'm going to qualify because once quarter 1 qualifies, the subsequent quarter automatically does. Quarter 2, I'm above 50%, but below 80. So that means rollover quarter 3 will qualify. Now, quarter 3, I went above 80. It's still a qualifying quarter, but it means quarter 4 won't automatically qualify. Quarter 4 is below 80%, but since it has to qualify on its own, it would have had to have dropped below 50% to qualify. So in this example, I have 3 qualifying quarters. FTE counts are very, very important. We look to 2019 to see what FTEs, or full-time equivalents, are for wages in 2019. So if you have over 100 average FTEs in 2019, then only wages paid for an employee to not work, either because the business has been shut down or that the receipts have dropped significantly, will qualify for the credit. So in our example here, we have a restaurant. If it has over 100 average FTEs in 2019, we're going to assume that it moved to a takeout only menu due to COVID restrictions for Q2, 3, and 4 for 2020. Anyone that performs services, even with reduced hours, is not eligible in this circumstance because FTEs are over 100 for 2019. So if you're bring back some people to be runners for the food to go out, maybe you're only giving them 20 hours a week and they're used to working 32. None of their wages are qualifying for this credit, even though they got reduced hours. If you paid anyone to not perform services, such as maybe got some servers, maybe got some bartenders, et cetera, that you may have decided to keep on the payroll, in that circumstance, those people who are not working, you can claim a credit for those wages paid. But what if there were fewer than 100 FTEs in 2019? Then you'd be able to take the credit on all wages for the quarter up to the maximum of $10,000 per employee per year. So the kitchen staff that prepared the meals and the servers you paid while they were at home, both those groups would qualify for this credit. FTEs are paramount. So then what you watch, so you have to see if you have an eligible quarter. You have to look at what your FTEs were for 2019. You have to calculate your allowable wages with the understanding that no employee can have more than $10,000 per year, which means mathematically the maximum credit per employee is $5,000 per employee. But really, what are wages? Well, wages are, payments for services, right? But that in this case, it also includes certain healthcare costs. And you may wonder why they include healthcare costs. Well, one of the reasons, if you think about it, many businesses put employees on furlough that may not have paid them a wage, but by having them on furlough, it allowed the employer to continue to pay healthcare costs. So what they're saying is the employers that put people on furlough and paid their healthcare costs, you can use those healthcare costs for purposes of the employee retention credit. What about related parties? Can I just hire all the people I know and bring them in, and I can get a credit for paying those people? It's pretty nice, isn't it? Because there's no rule that says the people I'm paying had to have been there in 2019, is there? Well, to prevent owners from hiring relatives and receiving employment tax credits, wages paid to certain people are not eligible for the retention credit. Now, when you look at who's an owner, it's people who own 50% or more of capital or profits. So if you got two 50-50 owners, it's gonna be both people are deemed owners for this. So if you're related to either one of those people, if someone owns more than 50%, it's gonna be only the people that are related to one owner. If nobody owns 50%, then we're not gonna have any restrictions on who can be hired and get a credit. These relationships are the same as other employment tax credits. So that's where they're getting their list from. They're referring back to the other employment tax credit section. So now let's look at who those people are. These relationships are different than normal attribution. So let's take a look at what these relationships really are. You cannot hire your child or your grandchild. You can't hire your brother, sister, stepbrother, or stepsister. Can't hire your father or mother or your grandmother or grandfather or stepfather or stepmother. You can't hire your nieces or nephews. You can't hire your aunts or your uncles. And you can't hire son-in-law, daughter-in-law, father-in-law, mother-in-law, brother-in-law, sister-in-law. It's kind of a different definition section, isn't it? But there's really an important thing here that's not listed. What about the owner and their spouse? Can I take a credit for them? And they're not on the list. So yes, you can take a credit for them. Now, I always try to figure out some logic for rules. And the logic I'm using here for this rule is that mom and pop businesses usually have both mom and pop as employees, but not all their relatives. So if you're a typical mom and pop business, we'll let you claim a credit for mom and pop because they are expected employees of your mom and pop business. So let's put some math to it. So if Q2 and Q3 are eligible quarters for the retention credit, and assuming that these wage amounts are both wages and health insurance for these people, what is my credit? So what we have is Abby earned $6,000, $7,000, and $5,000 in the 3 quarters. Bob gets $10,000 every quarter. And Chris goes $20,000, $15,000, $6,000. what happens? Well, so let's look at the credit for eligible wages here. So quarter one, nothing qualifies. Why? Because it wasn't a qualifying quarter. The reason I wanted to list wages for quarter one, though, is to show that in the example, since I didn't use any of the wages in quarter one, those wages do not impact my quarter two calculations. So in quarter two, I'm listing for Abby, she was paid $7,000. So that is her wage for Q2. Bob was paid 10. He's capped at, I'm using all the wages, but that happens to be the cap. Chris was paid more than 10, but I'm capping him at 10. So I have a total of $27,000 of qualifying wages in this quarter. My credit rate's 50%, so that means I get a credit of $13,500. In quarter three, even though it's a qualifying quarter, I'm going to add $3,000 of Abby's wages. I know she was paid more than that, but remember, my maximum amount of wages for any one employee is $10,000 for the year. So I have $3,000 left for Abby. Bob and Chris have already capped out at 10, so I don't get to count anything there. So my total for Q3 is $3,000, 50% credit, $1,500 is my actual credit allowed. Like any good seminar here, we have to have a polling question. So read the following statement. Employers can only receive a retention credit if they have a reduction in revenue for calendar year 2020. Is that true or is it false? Well, that statement is false because remember, you could have a shutdown in your period of time and you have a qualifying credit. But also it's not true on another level because there's a possibility for having a credit for 2021. This is brand new. Remember, the retention credits were not supposed to apply to 2021. They've been brought back for 2021. The credit for 2021 is far more generous than 2020 on a many levels. The credit wages are capped at $10,000 in wages per employee per quarter. So it's not $10,000 for the year, it's $10,000 for the quarter. The wages are only the wages paid from January 1st to June 30th. So it's quarter one and quarter two. Your credit rate is 70% versus 50%. The decline in revenue needed to prove a qualifying quarter is no longer 50%, but 20%. The FTE accounts for allowing you full wage coverage is 500. So if you have more than 500, you only get a credit for qualifying people that were not providing services. But if you have 500 or less, then you're going to get credits for people, even if they were providing services for that quarter. So greater wages, greater percentage, lower decline in gross receipts, more FTEs, additional period of time, substantial expansion, substantial potential dollars. So an employer can claim the employee retention credit if you're in business in the first 2 quarters of 2021, and you were shut down for part of the time, or you had a 20% decline in gross receipts compared to the prior quarter. Now, when you read all this here looks very comprehensive and confusing, and this is the way the language is written. So if you look at it, it says the credit cannot be more than the OASDI tax. That is Medicare and Social Security. Old age and survivors disability insurance. That's what Medicare and Social Security are called. So you can offset those taxes, and then you can get a refund for amounts in excess of that. That's what this is trying to say. So there's a lot going on here. They also have certain credits that are going to offset the amount. So you can't have to watch for business research expenditure credit, as well as qualified veterans employment credits and qualified sick leave and family leave wages. But when you're evaluating your decline in gross receipts, it's only 20%. So there also is a safe harbor. Safe harbor is new. So what you do is you look at to the prior quarter, and if the prior quarter would have qualified, then the current quarter qualifies with that, with those gross receipts reductions. But what are gross receipts? So if you think about a for-profit company, it's going to be your sales. It's going to be amounts received for services and income from investments. Period for the credit is the first 2 quarters of 2021. But the safe harbor is new. So you will have a qualifying quarter if the preceding quarter is 80% or less than the same quarter in 2019. So if quarter 4 2020 is 80% of quarter 4 2019, the quarter qualifies. If quarter 1 qualifies, if quarter 1 itself is 80% or less of quarter 1 of 2019, the quarter will qualify. Probably a lot easier to understand with an example. So here are my revenues for quarters 1, 2, 3, and 4, same amounts as the prior slide. I just have added in the first 2 quarters of 2021. So if gross receipts for quarter 1 are 85% in 2021 relative to 2019, looks like the quarter doesn't qualify. Why am I saying it does qualify? Because if I look back to quarter 4 of 2020 relative to quarter 4 of 2019, I do qualify. So that means I can use the safe harbor and say quarter 1 qualifies. Quarter 2 itself is less than 80% relative when I look at quarter 2 2021 to quarter 2 2019. So I'm saying that here I'm using the safe harbor for Q1 and I'm using actual results for Q2. This is not written anywhere. It's the way I'm interpreting the rules. Maybe further guidance might change it, where if you use safe harbor, you have to use it all the way through. But if you think of how safe harbors work in areas like estimated tax payments, you can use safe harbors for some quarters, you can use actuals for other quarters. We're using the same concept in this example. And this is how I would do it if I was helping a client today. We'll see if further guidance changes this down the road. The extension of the employment tax credit covers wages from January to June of 2021. When you compare FTEs, you're looking back to 2019. So remember, we're looking at 500 now, not 100. So that's a big, big swing. So more people will qualify for the full credit on full wages to employees versus It's just the people that are not working. So if I assume that Q1 and Q2 are eligible quarters for this retention credit, what is my credit? And assuming that here again that my wages include eligible health care, et cetera. So I had quarters 1, 2, 3 for Abby, Bob, and Chris, and I said everyone was paid the same. And 2021 is my prior example. So here, Abby qualifies to her full amount of $6,000 that she was paid in quarter 1. Bob qualifies at his wages of $10,000. Chris is paid more than 10, but he's capped out at 10. Add those together, I get $26,000 of wages. My credit percentage is 70%. It gets me to a credit of $18,200 for just quarter 1. Quarter 2 is also qualifying. Now, Abby, I get to include all her wages, again, $7,000. So even though the total's more than 10, the individual quarter is not. Bob, I get his $10,000 again. Chris was capped out in Q1. He's also caps out in Q2 of $10,000. But again, the fact that it was capped out in the prior quarter does not, it means you get to start all over and pick up a new cap this quarter. So I have $27,000 of wages for Q2. 70% credit gives me to an $18,900 credit. So in this example, look at the mass expansion of the potential credit. So I had $30,000 of wages in 2020. It gave me a $15,000 credit. In 2021, I had $53,000 of credit of eligible wages, a 70% credit, which gets me to a $37,100 credit. Credit more than doubled. But now you can receive this credit even though you got a PPP loan. However, you can't use the same wages for the credit and for PPP forgiveness. So you can't double count the same wages. Well, this is going to play some trickiness when we're evaluating what we really want to do. So I have conflicts between the two systems. To maximize the employee retention credits, you want to wait as long as possible to apply for the second draw PPP. Remember, you have to apply before March 31st. But the longer I wait, the more I'm going to have wages that qualify for the employee retention credit that won't impact my PPP loan because they're paid before I received the PPP loan. But this risks out on losing out on PPP. So while you want to wait, you want to make sure you qualify. You want to make sure that the program's not running out of money. So you just want to watch how that pulls together. To maximize forgiveness, you want to use as much payroll as possible for the PPP forgiveness application, but this risks out on losing on employee retention credit. So what are you going to do? Which one wins? Our advice is to use hindsight to your advantage. To maximize both benefits, it will probably require amended payroll returns. So it may be to your advantage to just file the payroll returns without the retention credits if you're going to get a PPP second draw loan. And what you're going to do then is, after you've gotten through your period for forgiveness, we'll figure out what's best. Are employment credits better? Is PPP forgiveness better? It's also going to mean more documentation required for forgiveness applications, as you're going to be using some of these costs like profit sharing and unemployment taxes to help to count as payroll for PPP forgiveness that are not counted as wages for the employee retention credits. So we're going to want to look to see what's going on. Probably have to provide more documentation when we're going forward. But overall, it's to your financial benefit to do these things. So take a look. It's going to mean getting a delay in getting some of the dollars, but this flexibility can really make some significant financial changes. Another common question is what happens if I've already applied for PPP forgiveness for the first round and I want to go back and claim these credits? Our advice right now is just hang tight. The SBA does not want a bunch of amended forgiveness forms. And there's organizations working behind the scenes, such as the AICPA, and they want to clarify with the SBA, okay, you've changed the rules, Congress has changed the rules. Let's go back and maybe just have people keep documentation on their files for what's really going on, how things worked out versus having to reapply. So just watch. We expect more guidance to be coming out in the future, but hang tight, and we're monitoring the situation, and we'll let you know when we hear more. As you can tell, this is an ever-evolving process. There's a lot of extra complexities that are going on because of this evolution. So as always, if you have any questions, you can reach out to myself, my contacts here, or any of our JAK team members and ask questions. We're glad to help you as we're able to. And stay in tune. We're going to keep putting out these seminars as conditions warrant. Have a great day.